futures is having a moment right now, and I feel like half the trading community hasn't caught on yet. Welcome to episode 13 of the Join Prop podcast.
Are we sure half the community hasn't caught on? Because looking at the data we have for this deep dive, it feels like everybody is rushing the gates right now.
Well, the smart half is. It's half paying attention to the actual money flow. But let's set the stage for everyone listening, because if you aren't in this specific ecosystem yet, what we're about to talk about is going to sound like pure late-night infomercial fiction.
It really does.
Right. So I want you to imagine you're sitting in your living room. It's a Tuesday.
Mm-hmm.
You pay like 30 or 40 bucks online, basically the price of a DoorDash order. You take a digital trading test, and 2 weeks later, an actual financial institution hands you the keys to an account with $150,000 in buying power.
And no background check, no degree.
Exactly. No Series 7 license, no resume. They just say, here's the capital, go trade the global markets and keep 90% of whatever you make. Oh, and if you lose money, they just close the account. They don't come after your personal bank account. Your total risk was at 30 bucks.
See, if someone pitches that to me, I'm immediately walking away. That is a scam.
It sounds exactly like a scam. I would think the same thing.
Sure.
But we are looking at this massive stack of data today, this 2026 industry report, and it proves not only this real, but it quietly become one of the biggest wealth transfers happening in retail finance right now.
Yeah, the numbers, honestly, they're hard to wrap your head around.
Okay, let's just hit the numbers right away.
Yeah.
Because they forced me to read the paragraph twice.
Mm-hmm.
According to the source data, futures prop firms distributed over $325 million globally in 2025.
Just to retail traders, like everyday people.
Yeah. Yes. Over $300 million in pure payouts. And look at the biggest player in the space right now. The report highlights Apex Trader Funding. Since 2022, they have paid out a cumulative $598 million.
That's $500 million.
More than $500 million. And it's accelerating. By late 2025, Apex alone was hitting $15.4 million a month in payouts. $15.4 million. Every month.
Okay, wait, stop. $15 million a month.
Yep.
Where's that money actually coming from? Because if traders are only paying 30 or 50 bucks to take this test, the math doesn't work. Like if they are wiring out $15 million a month to guys trading in sweatpants, that feels like a Ponzi structure. Are they just taking the test fees from the losers and handing it to the winners?
It's not a Ponzi.
I'm not saying they're doing something illegal. I'm saying it feels like a Ponzi scheme.
Right. No, I hear you, but the distinction is critical, because that's the difference between a legitimate futures firm and a total scam. To answer where the money comes from, you have to understand what proprietary trading or prop trading actually is. Historically, a prop firm is just a Wall Street institution that trades its own money.
Like a hedge fund?
No, a hedge fund takes outside investors' money and charges a fee. A prop firm trades its own balance sheet. Yeah. So think of like the classic 1980s trading floor. A firm hires 50 Ivy League math geniuses, pays them massive salaries, and lets them trade the firm's capital.
Right, the traditional Wall Street model.
Exactly. But think about the overhead there. You're paying millions in base salaries, you're paying for Manhattan real estate, Bloomberg terminals, all before anyone even executes a profitable trade. The modern futures prop firm looked at that and said, this is incredibly inefficient.
Because talent is everywhere.
Yes. Trading talent is global, but the capital was heavily centralized in New York or Chicago. So these modern firms decentralized the trading desk. They moved it online, and they flipped the risk upside down. Instead of paying 10 guys a massive salary to sit in an office, they crowdsourced their alpha.
Alpha being?
Alpha is just market returns, profit. So they offer these super cheap online evaluations. They can test hundreds of thousands of people from around the world at literally zero risk to the firm.
Because the trader is paying for the interview.
Exactly. The firm makes money processing the pipeline. Yeah. But when they finally find a trader who is an absolute killer, someone who is consistent, disciplined, they give them real institutional capital. The $15 million a month that Apex is paying out, that is not evaluation fees. That money is coming directly from the global futures market.
Wait, break that down mechanically.
So the funded trader clicks buy on their laptop. The firm's software routes that order to the actual financial exchange. Mm-hmm. If the market goes up and the trader sells, they just pull real dollars out of the global market through the firm's master account.
Okay, so the firm takes a massive cut.
Just 10%. The firm takes 10% and passes 90% to the trader. So their bet is that if they can find a few hundred incredibly skilled traders out of 1 million applicants, that 10% cut will generate immense wealth for the firm without employing a single one of them.
It's venture capital, they're micro VCs.
Exactly. It's the venture capital model applied to day trading. And to understand how we got to these crazy payout numbers, you have to look at the massive migration happening right now. The report dedicates a huge section to this. People are abandoning one specific type of trading and flooding into futures.
The search volume data in the report is wild.
It is. By December of 2025, global monthly searches for futures prop firm hit 19,100. At the same time, forex prop firm was at 12,200. Futures has completely taken over.
So people are just bailing on forex.
It's a mass exodus, honestly. It's like everyone suddenly stood up, left this shady underground poker game, and walked into a highly regulated casino with a gaming commission.
Okay, but why? I feel like a lot of people listening hear futures and forex and just lump them together as, generic day-trading terms. What is the actual difference between them?
It comes down to structure and regulation. Let's look at forex first. Foreign exchange. You're trading currency pairs, right? Betting the euro goes up against the dollar. The defining characteristic of the forex market is that it is OTC, over-the-counter.
Meaning there isn't a central building.
Right. There's no central exchange matching buyers and sellers. It's just a decentralized network of banks and retail brokers. Because there's no central hub, when a retail trader places a forex trade, their broker is very often acting as the counterparty to that trade.
Wait, what do you mean counterparty?
It's called B-booking. If you click buy on the euro, the broker doesn't actually send your order to the global market. They just hold it internally on their own books. They are the ones selling it to you.
Okay, wait. So if they take the other side of my trade, if I win, the broker loses their own money.
Yes.
And if I lose, the broker just pockets my cash.
Yep. You see the problem?
That is a massive conflict of interest. They are literally financially incentivized to see you fail.
100%. If you start making $1 million, you are draining your broker's bank account. This is why forex has such a shady reputation. They have every reason to manipulate the software or freeze your screen or widen the spread right when you're trying to sell.
Because they're losing money.
And in the unregulated forex prop firm space, it was even worse. To dodge oversight, a lot of these forex firms wouldn't even put you in a live market when you got funded. They kept you on a simulated demo account.
So you're trading monopoly money.
Yes, even when you're funded. The firm was just paying the few winning traders out of the pocket of the challenge fees collected from the losers. It was an internal Ponzi-like structure. If too many traders won at once, the forex firm simply wouldn't have the cash to pay them. They would just vanish overnight or use some obscure rule on page 40 of the terms of service to deny your payout.
Okay, so that's the unregulated poker game where the dealer can just flip the table if you win too much.
Exactly.
Yeah.
Now contrast that with futures. A futures contract is a discrete, highly regulated financial instrument. It's an agreement to buy or sell an asset like oil, or the S&P 500, at a specific price on a specific date. Because it's a discrete contract, it has to be traded on a centralized exchange, like the CME, the Chicago Mercantile Exchange.
So there is a central hub.
Yes. Everyone in the world, a hedge fund in London, a retail trader in Ohio, is looking at the exact same price feed, the exact same volume, at the exact same millisecond.
That fixes the manipulation problem.
Totally. And the exchange acts as the referee. They use a clearinghouse. So when you buy a futures contract, the prop firm routing your trade isn't taking the other side of your bet. They don't care if you win or lose. The exchange matches you with another trader somewhere in the world, and they just collect a tiny fraction of a penny as a toll fee.
So if I make $1 million, I'm just taking it from whoever was on the leasing side globally, not bankrupting my prop firm.
Exactly. And the whole thing is overseen by the NFA and the CFTC in the U.S. These are incredibly strict federal regulators. They require massive capital reserves, audits, segregated funds.
So the migration is really just a flight to safety. Traders want an ironclad guarantee that if they put in the hours and actually win, the money will show up in their checking account.
Right, because regulatory clarity is the best marketing tool you can have right now.
Okay, but getting to that payout, getting your hands on that NFA-regulated capital is the catch. You don't just walk in and ask for $100,000. The report outlines the evaluation phase, and the economics of this are fascinating. We mentioned the challenge fees are low, $30 to maybe $500.
Super accessible.
And the timeline is insane. You only need 10 to 15 trading days to pass a single-phase challenge, pay $50, trade well for 2 weeks, get funded. But, and this is a massive flashing red warning light, the industry pass rate is a dismal 5 to 10%.
Yeah.
90 to 95% of everyone taking these tests fails.
And that failure rate is completely by design.
This is where I have to call this out. That is literally their business model. If an institution knows that 95% of its applicants are going to fail, I'm sorry, but who is the real customer? Is it the successful trader? Or is the firm just farming the thousands of desperate people paying $50 to fail?
Look, it's the most common critique of the industry, but you have to look at how the math actually works. Think back to the venture capital analogy. Does a VC want 9 out of 10 of their startups to go bankrupt?
No, but a VC isn't charging the startup an application fee. The prop firm is.
True, and I'm not going to pretend the firm doesn't rely on that revenue. The sheer volume of people paying $50 to fail creates massive cash flow. It covers their data feeds, their software licensing, their server costs. But, and this is the key, that evaluation money just keeps the lights on. The truly life-changing revenue for the firm comes from the funded traders.
How? Explain why a winner is so much more valuable than 1,000 losers paying $50.
Recurring revenue. A failing trader pays $50 once, blows the account in 2 days, and maybe pays another $50 to try again. But a highly skilled funded trader who pulls 20 grand out of the market every month, the firm's 10% cut is $2,000 every single month from one person.
Okay, I see that.
And that is pure alpha. That's money generated from the market, not from marketing. The firm desperately wants to find those consistently profitable traders. But the only mathematical way to find them is to cast a massive net and let the masses filter themselves out through a brutal test.
So it's a sorting hat. The evaluation fee pays for the net, but they really just want the bluefin tuna.
That's exactly it.
Yeah.
But we need to look at why the failure rate is 90%. Because the market isn't rigged against them. It's the psychological pressure cooker of the rules.
Let's talk about that 10 to 15-day timeline. Because if you tell an amateur trader, hey, you have to generate a 10% return and you only have 2 weeks to do it, you are actively encouraging reckless behavior.
You are. The time constraint is a weapon.
If I know I have to make $3 grand by Friday and the market is flat, I'm going to force a trade. I'm going to double my leverage just to hit a home run.
And the second you double your leverage, the market ticks against you, you hit your loss limit, and you fail. The timeline exploits human impatience. The firm knows amateurs feel like if they aren't in a trade, they aren't working.
So the test isn't, can you read a chart? It's, can you sit on your hands for 4 days and wait?
Yes. It identifies the truly disciplined 10%. But if you are one of those disciplined people, you need to know you are fighting in the right arena. The report spends a lot of time on the top players in the space for 2026, the titans of the trade.
Right, because the industry has really consolidated around a few massive firms. Apex, Topstep, My Funded Futures, Lilu, and Earn2Trade.
And the incentives they offer to get you to take their evaluation are wild. They all offer a roughly 90-10 profit split. But firms like Apex and Topstep go further. They offer 100% retention on the first $10,000 to $25,000 you earn.
That's such an aggressive acquisition strategy. It feels like a grocery store loss leader.
It is a massive loss leader.
But I have a question about this. If I'm a trader and I pass the test and I grind out $25,000, keeping 100% of it, why wouldn't I just withdraw that 25 grand, put it in my personal brokerage account and trade for myself? Why stay and give them 10%?
This is the most fascinating dynamic in the whole industry. It's called trader graduation. And it is the existential threat to every prop firm. They are terrified of funding a brilliant trader, letting them build capital and watching them leave.
So why offer the 100% payout? You're literally giving them the seed money to leave.
Because you're using psychology against you again. Golden handcuffs. Let's walk through the reality of that scenario. To make 25 grand in a prop account, you are probably using the buying power of $150,000 or even a $300,000 account.
Right, massive leverage.
Massive size. You're trading 5 or 10 contracts at a time. Now you withdraw your 25 grand and put in your own account. Suddenly you don't have 300 grand in buying power. You have exactly 25. You cannot safely trade the same size. Your profit potential shrinks drastically.
Oh, wow. I didn't think about the buying power reduction.
And it gets worse. If you trade your own money, you have to pay for your own institutional data feeds, which are hundreds of dollars a month. You pay for your own charting platform. And, most importantly, if you have a bad week and lose 5 grand, that is your actual personal money vanishing.
Whereas with the prop firm, my personal risk was 0. The worst case was I lose the account and pay $30 to take the test again.
Exactly.
Yeah.
So they give you the 100% payout at the start to get you totally addicted to their ecosystem. The massive leverage, the free data, the lack of personal risk. By the time the 90-10 split kicks in, giving them 10% feels like a totally reasonable tax to maintain your lifestyle and protect your own wealth.
That is brilliant behavioral economics. They make the pain of leaving greater than the pain of paying the 10% fee. What about the scaling they advertise, though? The report says Apex scales accounts up to $6 million. Is anyone actually managing a $6 million account from their couch, or is that just marketing fluff?
I mean, it's aspirational marketing grounded in a mathematical reality. Very few people will ever reach the consistency to unlock a $6 million tier. You have to prove profitability over months or years without hitting a drawdown. But technically, yes, the infrastructure is there. The firm would gladly hand $6 million in buying power to a statistical anomaly.
The report also contrasts the billing models. Like, Topstep and Earn2Trade use a monthly subscription for their evaluations, maybe $49 a month until you pass. But My Funded Futures uses a one-time variable cost. How do you choose?
It requires extreme self-awareness. If you are a methodical swing trader who waits for perfect long-term setups, a monthly subscription will bleed you dry. It might take you 3 months to hit the profit target.
So you've paid the fee 3 times.
Exactly. So for you, a one-time fee firm makes vastly more mathematical sense, even if the sticker price is higher. You are buying the luxury of time. But if you are a hyper-aggressive scalper planning to pass in 5 days, you take the cheaper monthly subscription, pass immediately, and cancel the billing.
Okay, so we have all these enticing offers. 100% payouts, $6 million scaling. But we know the failure rate is 90%. Traders need a way to spot the traps. And the report outlines this faster framework for filtering firms.
It's basically a survival guide for reading the fine print.
Right. It stands for funding speed, account rules, scaling potential, trustworthiness, evaluation fairness, and risk parameters. I want to zero in on the killer here. When I look at A for account rules, the report talks heavily about the trailing drawdown, usually around 10%, with daily loss limits of 3 to 5%. You need to explain this because I feel like this is the trapdoor.
You have zeroed in on the exact mechanism that funds the industry. The trailing drawdown is the most psychologically devastating rule in prop trading.
Explain it mathematically. Walk me through a trade.
Okay, let's say you pay for an evaluation. The firm gives you a simulated $100,000 account. They say your maximum allowable drawdown is $3,000, meaning if your balance ever drops to $97,000, you instantly fail. Account locked.
Simple enough. I have a $3,000 safety buffer.
That's a static drawdown. But this is a trailing drawdown. The failure threshold of $97,000 is not locked. It trails behind your highest high water mark.
Okay, so if I take a trade and I go up $2,000, my balance is now $102,000. What happens to my failure threshold?
It trails up by that exact same $2,000. It's no longer $97,000. Your new failure point is $99,000.
Wait, stop. If my failure point is $99,000 and my starting balance was $100,000, my failure point is now lower than where I even started.
Yes.
But I still have a $3,000 buffer, just higher up. That doesn't seem that bad yet.
Oh, it gets worse. Because most aggressive firms use an intraday trailing drawdown, meaning it follows your unrealized profits while the trade is open and moving.
Oh no. Walk me through that.
You enter a trade, the market surges. On your screen, you see you are currently up $5,000. Your account is technically at $105,000 at that exact millisecond.
So my trailing drawdown violently yanks up behind me. My new failure point is $102,000.
Exactly, $3,000 behind your highest open profit. But you don't close the trade. You think it's going higher. Instead, the market reverses. It drops back down. You panic and close the trade when you only have a $1,000 profit.
Okay, so I started with $100,000. I closed the trade. My final balance is $101,000. I made $1,000. I'm green for the day.
You are green, but you just failed the evaluation and lost your account.
Because my balance dropped to 101, but my trailing drawdown locked in at 102 when the trade was at its peak.
Yes. You failed the evaluation on a trade that actually made you money simply because you let a massive unrealized profit retrace too far before closing it.
That is absolutely brutal. That completely destroys the whole let your winners run philosophy. It forces you to become a hyper-anxious micromanager.
It acts as an immense psychological pressure cooker. You cannot let a winning trade turn into a break-even trade because the trailing drawdown will snipe your account. This is why the E in the faster framework evaluation fairness is so vital. You have to look for firms that calculate their drawdown at the end of day based on your closed balance rather than tracking every single intraday tick.
Because an end-of-day drawdown lets the trade breathe.
Exactly. Intraday trailing drawdowns are the silent killers generating that 90% failure rate.
Let's look at the T then. Trustworthiness. We established they are actively deploying psychological traps to weed people out. How do you measure trust in an environment designed to make you fail?
Trust boils down to one undeniable metric. It isn't Trustpilot reviews. Those can be botted. It isn't a sleek website. It is verifiable payout history. Do they actually cut the check when a trader survives the gauntlet?
And this brings us full circle to the futures migration. Because they are NFA and CFTC regulated, the money trails are transparent. If Apex says they paid out $15 million last month, there is an auditable banking trail proving it.
Yes. So a smart trader wants the obstacle course to be incredibly hard, but they want the prize at the end to be a mathematical certainty. You want the difficulty to come from the market, not from the firm's accounting department.
Okay, so having dissected all these mechanics, we need to pull the lens back. We have to look at the massive macroeconomic forces pouring gasoline on this industry in 2026, because something else is driving this unbelievable growth.
There are two specific data points at the end of the report that stood out to me. First, crypto derivatives experienced a massive 139% year-over-year growth in 2025. And second, futures prop firms are seeing lower customer acquisition costs because the incoming wave of retail traders has a much higher average skill level than previous generations.
See, I found a massive contradiction there.
How so?
If the average retail trader is significantly smarter today than 5 years ago, why is the failure rate still locked at 90%? If they are so skilled that the firms barely spend marketing dollars to acquire them, why are they still blowing up their accounts in 10 days? Are the firms secretly making the tests harder behind the scenes?
It's a logical assumption, but it's not what's happening. You have to separate what the evaluation measures versus what the trader has learned. You're right that the technical skill of the retail market has skyrocketed.
Because of YouTube, Discord, free charting software.
Exactly. A 22-year-old kid today has access to real-time order flow data that hedge funds paid millions for in the 90s. They know what a supply zone is. They know how to analyze a chart.
So why are they failing?
Because human psychology hasn't evolved as fast as the software. We still have caveman brains operating supercomputers.
Explain how the caveman brain fails the test.
Behavioral finance proves this constantly. Look at loss aversion. Humans experience the pain of losing money twice as intensely as the joy of making the exact same amount.
Losing $100 ruins your day. Finding 100 is just a nice bonus.
Exactly. Now apply that to a highly skilled 22-year-old in an evaluation. They take a trade based on perfect technical analysis. The market unexpectedly drops. They're down $200. The technical analysis says close the trade, take the small loss. But the caveman brain cannot accept the pain of the loss.
So they hold it, hoping it bounces back.
Worse, they average down. They double their position size while losing, thinking if I buy more at a lower price, I only need a tiny bounce to break even. They let their ego override their skill. The market drops another inch, they hit their daily loss limit, and they're liquidated.
Or they take the loss, get furious, and immediately revenge trade with max leverage to win it back in one shot.
Yes. So the lower acquisition costs just mean millions of young people who know how to read a chart are eagerly signing up thinking their technical edge guarantees success. They don't realize their edge is useless without absolute robotic emotional discipline. Greed and fear are unhackable filters.
That makes perfect sense. The tools are better, but the human is flawed. But what of the crypto aspect? The 139% surge. The report mentions regulated futures firms are aggressively offering crypto futures like Bitcoin and Ethereum. How does injecting highly volatile crypto into an NFA environment change things?
It's the ultimate synthesis for the modern trader. Think about the demographic entering finance recently. They grew up watching Bitcoin go from hundreds to 60,000 and back. They're accustomed to face-melting volatility. A 1% move in the S&P 500 is boring. They want 10% intraday swings.
They're volatility junkies.
Exactly. But historically, to trade crypto with leverage, they had to use offshore, unregulated exchanges. And we've seen how that ends. Frozen withdrawals, hacks, bankruptcies where funds just vanish.
So they're stuck. They want the wild action of crypto, but they're terrified of unregulated scams.
Enter the regulated futures prop firm. The CME offers NFA-regulated micro Bitcoin and micro Ethereum contracts. These track the exact price movements of the crypto assets, but they trade on a transparent, government-regulated exchange.
So prop firms just added these CME contracts to their tests.
Yes. And it was a massive catalyst. It bridged the two worlds. They gave traders the extreme volatility they crave, which allows them to hit profit targets much faster if they're right,
Yeah.
but under the ironclad safety umbrella of the NFA and CFTC.
You get the thrill of the crypto casino, but with the security of an audited bank.
It opened the floodgates for crypto traders to migrate into traditional futures. It's a huge reason payouts exploded in 2025.
So pulling this all together, we are looking at a financial world that has been permanently, structurally altered. You have strict regulation pulling people from shady forex brokers, hyper-volatile crypto derivatives giving a new generation action, and massive capital, hundreds of millions of dollars flowing from global markets directly to retail traders in their living rooms.
It's a profound shift, the ultimate decentralization of the institutional trading desk. To synthesize the takeaways for you listening, the opportunity here is incredibly real. It's not an infomercial scam. It's backed by auditable payouts and strict regulators. You genuinely can get funded with a six-figure institutional account for the cost of a pizza. But the true barrier to entry is no longer capital.
The barrier is extreme psychological endurance.
Exactly. The gauntlet of trailing drawdowns and time limits ensures only the most emotionally controlled robotic traders see a dime. You aren't battling the market, you're battling your own caveman brain.
And that leads to a final, larger implication that the report doesn't mention, but it's fascinating. We talked about scaling up to $6 million in buying power.
Right, the apex predators of the prop firm world.
Think about the macro impact. If retail traders, armed with AI indicators and zero emotional baggage, continue to get scaled accounts of that magnitude, what happens to the market structure? At what point do decentralized retail traders on Discord become the institutional whales themselves?
Oh, wow.
If 10,000 elite retail traders, all managing $6 million, spot the exact same technical setup on the S&P 500, they aren't just participating anymore, they are swinging billions in notional value. They are dictating and moving the global markets.
That is terrifying and incredible. The minor league players pulling their leverage and suddenly owning the stadium. It flips Wall Street on its head. So next time you see a massive move in the markets, the person moving that price might not be a guy in a tailored suit. It might be a wildly disciplined kid in a hoodie, wielding a $6 million account he got for passing a $30 test. Keep questioning the mechanics, and we will see you on the next Deep Dive.